panel will be moderated by our own Chief Financial Officer, Nate Barber.
I guess I'll just follow the
you guys
the
can
order.
follow. So it's your show, Nate.
Thank you. I was told this mic was on. Testing? Okay, there we go. Apologize. Definitely on. Thank you, Luan. As Luan mentioned, it will be my pleasure to moderate today's first panel entitled Disrupting the Disruption. So joining us this morning are the founders and chief executives of 5 very exciting technology lending platforms, some of which John Barlow alluded to in this morning's address. So we're absolutely excited to have all our panelists here and look forward to this discussion. So our panelist platforms offer an array of innovative products focused on several borrower types, including consumers, small businesses, including the construction industry, and also students. So let me just go down the line and maybe make brief introductions. I'll leave the real introductions to the panelists themselves, but let me just mention who is joining us here this morning on our panel. So we've got Al Goldstein, who's the founder and CEO of Avant. David Haber, who is a co-founder and CEO of Bond Street. David Klein, co-founder, CEO, CommonBond. Krista Morgan, co-founder, CEO of P2B Investor. And James Nielsen, founder and CEO of CreditSuppliers. So terrific, and welcome to our panelists. Thank you for joining us today. So within the context of today's theme, we will discuss our panelists' perspectives on a few key areas, including how the peer-to-peer marketplace / marketplace lending industry has changed since inception and how it continues to evolve, and operational and strategic insights from folks in the trenches here, as well as views on industry and platform growth, capitalization-related issues, and last but not least, of course, our panelists' view of the future and what happens next for the industry. So with that, let's maybe kick off, Al, with you. Go ahead and just provide a brief introduction, and we'll move to questions.
Sure, thank you. And I see we're keeping the jeans trend alive up here, not maybe in the panel, but just trying to make Jonathan feel at home. So, thank you for having me. And Avant is the fastest growing online marketplace platform, really focused on what we define as middle-class consumers. Our definition encapsulates basically the 50% of consumers that are not subprime, not super prime, but really require better access to credit. We are just under 3 years old, have originated nearly $2 billion worth of loans in over 300,000 transactions. We now operate in the US, UK, and most recently Canada, and very much agree with Jonathan's perspective that multi-geography, multi-product is really the long-term vision. And really we're focused on expanding products and trying to meet the consumer demand across the different verticals in which they need to borrow.
Hi everyone, I'm Krista Morgan. I'm the co-founder and CEO of P2B Investor, and what we're providing are revolving lines of credit to growing businesses, and our niche is really to look at companies that have at least $1 million in revenue up to about 10 million, and we see that they're being really poorly serviced right now by alternative lenders that don't have good technology, have slow process, and actually don't have enough funding to really be able to take a business from, say, a $500,000 loan up to $5 million. And so our platform is all asset-backed revolving lines of credit. We focus on invoices and inventory. We've originated about $100 million in the last 18 months. And we're growing very quickly and very happy to be here.
Thanks so much for having me. I'm David Haber, co-founder and CEO of Bond Street. We started the business about a year and a half ago. I'd spent 3 years working in venture capital at a firm called Spark, looking a lot at this space. And while I'd spend most of my time talking to technology companies, I'd often run into fast-growing physical products businesses or services businesses that were also looking to raise financing, but didn't really fit within the mandate of what we were doing or really made sense for venture capital, but who were growing the revenues, were profitable, and either struggling to raise bank financing, or were very bankable but kept telling me how painful and antiquated the process was. And so we started seeing this sort of shift happen within the technology industry where financial software companies were starting to make all this data on the financial health of small businesses accessible via API. And so the genesis of the business really was, could we create a better customer experience, one that shrunk the time to decision from 4 to 8 weeks at a bank to today, 48 hours, by making it really simple for our customers to share all the data we need in a few-minute online loan application. So we offer $50,000 to $500,000 term loans today. We recently raised over $100 million of lending capital from Jefferies, and then our Series A round of financing from my old partners at Spark.
Hello, everybody. David Klein, CEO and co-founder of CommonBond. CommonBond is a marketplace lending platform that to date has focused exclusively on student loans. We serve a two-sided market, borrowers on one side, investors on the other. Borrowers on our platform save about $14,000 on average by refinancing their student loans with us. On the other hand, investors are able to make a competitive financial return, particularly given the underlying risk on our platform. So in the 2+ years at national scale now, we've yet to experience a delinquency, let alone a default. And so the thesis for us is really playing out that when you focus on a creditworthy borrower in the student space with strong upfront underwriting and really strong ongoing risk management practices, there's a really strong business there. And what it does is it sets up a platform for us to be a marketplace lender that serves our customer well over time and over asset classes. If you think about our average customer, just to let you know, they're 32 years old, making 6 figures with a FICO of over 760. That we think is a valuable customer that we can get 3 to 5 years before First Republic, about 15 to 20 years before JP Morgan Private Bank. And so we think there's a lot to do with this group, and to the extent we can serve them well with a simple and speedy process with their student loans, we think we're well positioned to be at the top of their consideration set as they continue to evolve their financial life cycle.
Good morning, my name is James Nielsen. I'm the CEO and founder of CreditSuppliers. We are a Scottsdale, Arizona-based company, and we've been providing revolving lines of trade credit to contractors. Because of our processes and systems, we can collateralize and cross-collateralize these lines of trade credit like nobody else, I've not seen anybody else do. Because of our systems and processes, we've now attracted both private and institutional capital that we bring on balance sheet and then use that to lend out in those revolving lines of trade credit. We've been doing this in Arizona for the past, over the past year, done multi-millions of dollars there, and now expanding our platform and taking it nationwide.
Terrific. Thank you to all of our panelists, and those introductions were very helpful. So with that, let's dive into the questions. So the first theme, as I mentioned, we'll focus on today is historical perspectives. And as I also mentioned earlier, all of our panelists are founders or co-founders of their respective financial technology companies. So this question is directed to sort of the founder element of your platforms. As founders, what inspired you to launch your company, and what big problem or issue in the financial landscape were you seeking to address? So, yeah, go ahead. Volunteer
I
first.
love being,
Sure.
Yeah, I picked the right seat. I love it. So Avant is, as I mentioned, just under 3 years old. My 2 co-founders actually happen to be former interns of mine from my first company, which is also in the category called Innova International. And they were actually in Y Combinator and building a separate business and didn't have any money because they were trying to do a startup. And one of my 2 co-founders went into a physical branch, I believe it was a Springleaf branch, to try to get a loan, and the computers were down, he had to come back. Eventually he got denied. And that experience, I think, really created the thrust for Avant, because at that time, as Jonathan alluded to, the marketplace lender community, really the P2P community, and this was 2012, was really just emerging and really not focused broad market. And I think we saw an opportunity to really focus on that consumer and change that experience and really expand across the consumer segment.
For us, I was living in the UK at the time, so I'd come across peer-to-peer lending pretty early on, and then one day I learned about factoring. And I took a look at what was available online, and you had like the receivables exchange and market invoice, and I liked the invoice by invoice I like the invoice-backed lending, but it was really high transaction for both investors and borrowers to constantly be selling invoices. So we really wanted to be able to create a framework where borrowers, we could do invoice-backed lending, but take out the sort of constant liquidity that investors were seeing and the work on the borrower side. And that was really how it came up. And it took a long time to figure out how to do the revolving line of credit, because our draws change every day and there's a lot of cash moving around. But we are very, now that we've cracked it, what we're seeing is it's a great product for borrowers, that they love being able to just draw when they need it and have a one-year agreement in place.
Yeah, I mean, as I talked a little bit about earlier, we were really trying to solve a pain point that we saw in the market, and also create a customer experience that we'd want for ourselves. It was shocking to me that you couldn't apply for a loan online at any bank in the country. You still had to print out your physical financials and walk into a branch, hand it over to a loan officer. At the biggest banks, they're often sending it to Texas, where somebody's rekeying in the financial information manually, and then 4 to 8 weeks later, the customer gets a decision, and 80% of the time it's a no. It seemed like a really painful customer experience, and one that should be solved with technology. The flip side was also wanting to start the business with my co-founder, Peyton Sherwood. Peyton was a few years older than me at school and had studied computer science, and then had worked at D.E. Shaw for 6 years directly for David Shaw in technology. Around the time that I joined Spark, he went to go run product and engineering at Venmo, which was a mobile payments business that was acquired by PayPal. So when that acquisition happened, basically said, okay, it's time to leave, and we both left our respective jobs at the end of 2013 to start Bond Street.
For CommonBond, it really came out of a personal pain of mine. I went back to business school on what I like to call the other side of average age, and needed to pay my way 100% with student loans. And when I went through the process, I realized a few things. One, rates were unnecessarily high, especially for creditworthy borrowers in the student loan world. Two, the process was unnecessarily complex. And three, the service was pretty poor. And so I come from a family of entrepreneurs. I went to business school expressly to start a company after spending about 10 years in corporate America at McKinsey and American Express. And once I had kind of stumbled upon this personal pain, I decided to take my background in finance, my entrepreneurial ambitions, and pretty much dedicate myself to this. I ended up meeting my two co-founders at Wharton Business School, which is where we all met and launched the company from. And we've been at national scale for about 2 years now. We'll do about $500 million in loans funded by the end of this year, and expect to surpass $1.5 billion next.
Well, the construction industry is about a $1.7 trillion industry, massive industry, right? But I'm going to blame this one on my wife. When we first met, her job was to go in Friday mornings, open up the drawer, go through the invoices, 60, 90 days plus, make that phone call, hey, Bob, can we get paid here? And what was Bob's answer? You'll get paid when I get paid. And I said, you know what, in this industry, there's got to be a better way. And it was taking that notion with understanding how asset-backed securities work, technology work, melding those together, and taking it out to these small businesses, these contractors. These are artisans. They're folks who want to focus on what they do, not necessarily the transactional part of it. And putting the team together so that we can get this capital out from the banks, out from alternative ways of getting that money, and out into their hands, focusing on the assets in their balance sheets. The key is what those assets are, not only just the receivables, but there's also assets and payables, and that's what we've been able to unlock.
Okay, terrific. Thank you. I know it's always inspiring for me to hear kind of the genesis of the business and sort of what ideas led you down the path of forming these respective companies. So let's move on. So the next question we'd like to throw out is one sort of also backward facing in terms of history. And although the marketplace lending model is a relatively new area in modern finance, we've certainly have come a long way during the past 10 years. And some of the industry's pioneers have even achieved public exits, as John Barlow mentioned this morning, which were very visible and very good for the industry. So the question is, what have you learned from observing some of these pioneers in the industry and the challenges they experienced? And also, what are you doing differently or incorporating into your model to sort of address these challenges? So perhaps we could start, James. You've been last these first questions, so go ahead and why don't you kick off? We'll go this way.
Yes, again, as I mentioned earlier, it's looking at the balance sheets of these companies and saying there's assets there. There's a way to collateralize and use that collateralization from those assets and not make just a one-time lend, but revolving lines of, as I mentioned, trade credit. And getting those assets changed from a long-term play to an even shorter term, a monetization of those assets allows our clients to grow and grow their businesses in significant ways. And I think it's really that trend to find where the arbitrage is on companies' balance sheets that then can play into the transformation that's going to lead us forward here.
For us, we learned pretty early on by looking at Lending Club and Prosper what happened between them and the SEC at the relative beginning of their respective developments. The SEC shut them down for months, and it was because they were focused on individual investors, and the SEC came in and said, well, if you're focused on individual investors, you've got to file with the SEC for every single transaction that you make with an individual investor. So they shut down for months and spent a good amount of money to come back online within 6 to 12 months and continue their platform to allow regular kind of Main Street investors to invest on their platform. And what we learned from that in the very early days was if we want to avoid pretty much millions in expense of both people, regulatory filings, overhead, our goal was then to focus not on the retail investor in a traditional sense, but on the accredited retail investors. If you focus on the accredited investor, you're exempt from a number of different securities laws. And so that's what we did when we launched our pilot at Wharton Business School. What we further learned after launching the pilot is that in a world where it's important to scale quickly, which is, I think, the world we live in today, to go around to individual accredited investors and ask for $25,000, $100,000, $250,000 checks one at a time can take quite a while. So from our pilot, we learned to concentrate our sources of capital a bit more. We've been focused on institutional capital ever since. I do agree with John in what he said in his remarks around how funding will revisit the individual piece. I can tell you in our plan, I hope and expect to bring the individual component, if only just the accredited investor component, back to our platform. It's not a 2015 thing, but I do see it on our roadmap going forward now that we've reached a particular level of scale and can build it from this angle as opposed to from an early stage startup.
Yeah, I think when we started Bond Street, there was still a pretty big chasm in the types of capital that were available to small business owners. There was a decision that had to be made. Either you were very bankable, but it was going to take you a long time to get funding, although the cost of that capital would be pretty low. And then there was a pretty large gap. And then it was credit cards, merchant cash advance, et cetera, that were often charging 30, 40, 50, 60, in some cases, triple-digit interest rates. Both, I think when we started Bond Street, it was partially a philosophical point of view that we didn't want to charge such high rates, but also, I think, a strategic one, as we really believed that the biggest opportunity in the market would play as close to the banks as possible. Ultimately, there's $1 trillion of market cap in the top 6 banks in the country. I mean, that's the massive opportunity, right? And I think the positive externality of that decision has both opened the landscape of states that we can afford to lend in. So we can lend today in 46 states across the country because we play beneath most state usury caps. The flip side of that, too, is that it's really opened a lot of really interesting partnership opportunities with companies who really valued their brand and felt uncomfortable referring a customer, who was walking into a bank, traditionally looking for a $350,000 loan at 6%, to another company offering $35,000 at 60%. And I think that's a really interesting shift. I think the last piece is really just the evolution of the customer experience. And I think this one is really ongoing. What I think most online lending sites have done is really allowed you to collect information, transact online, and sort of move on. I think, part of my philosophy, I think, going forward and building the business is there's such an opportunity to use technology to deepen your relationship with your customer, both earlier in their decision-making funnel and also after, and using the signal of the data we collect to actually predict and anticipate future financing needs.
So I absolutely learned, I think we got really good lawyers early on, and that was, that we spent more money than I care to have spent on that. But for me, the thing that I really took away from looking at the Lending Club and Prosper and Ondex of the world is brand. I come out of a marketing background, and I really believe that of all the marketplace lenders, there actually has not been great consumer branding coming out of this space. One of the things that we're working on a lot at P2BI is how do we build, a big brand in the likes of like the big technology brands that have been built, the B2B technology brands, the Salesforce. How do I make sure that when you're a CFO of a $5 million company, you're going to think about P2B investor and really being a challenger brand? I mean, we're alternative lenders. Like, we should be having, I think, more fun, just being a bit more radical in our approach to marketing, and that is something that I really care about, and I think is a big opportunity for us.
Maybe I want to talk about two things. One is, I think you defined the public exit. At Avant, and I think probably for a lot of us, we don't view an idea of an IPO in the future as an exit. We think that's an important step in how you build really large and transformative institutions. The fact that Lending Club and OnDeck are below their IPO price is obviously not how we would have all loved it to go. But I think that's telling us a lot as companies, and it's telling us that the market is getting much more focused on profitability, on diversity of product, on brand. And I think that's really what we're all very focused on. But going back to the beginning of, I would say, Lending Club and Prosper, I think at Avant, we looked at the fact that it took a really long time for the platforms to develop because they didn't have any credit history, and it takes institutional investors data to get comfortable. And so Avant had a decision to make, is do we structure like the existing platforms, but with a customer that on average has about a 650 or 660 FICO score, so it looks a little bit different, and take a long time to build up data at small scale? Or do we become a direct lender instead of a pure marketplace lender? Initially, we raise capital and we make loans ourselves. We take risk and build up that data that allows institutional investors to get comfortable. And that's the decision we made. The effect of that decision, though, has allowed us to, one, have a different funding model. So we have a hybrid funding model as opposed to a pure marketplace model. We make loans as well as make loans for Avant's book as well as for institutional investors. It allows us to not charge fees, which is one of the things that I think is pretty consistent in the industry. I personally believe that that will change over time. This idea that you pay an upfront fee, that the consumer pays an upfront fee that then goes to the platform, and then all of the risk gets sold, I think is something that is true today, but likely will not be true in the future. And so, in our view, that's kind of, as we look at the platform, I think fees, doing your own servicing, and making the process really real time instead of a 3, 5, 7 day process for the consumer are things that the existing platforms, I think, need to evolve to.
Okay, terrific, thank you. So I guess maybe to touch on, a couple of you touched on technology and automation in terms of your underwriting and really operational approach to the platform. So let's touch on that for a moment. So specifically, how is technology and specifically automation integral to your core business model? And how do you plan to leverage it in the future to enable your success? So let's maybe go in the middle with David Haber, and then we'll go to your right and mix it up a little bit.
I thought I was going to be passed, Yeah, look, I think as we think about who we serve, our core customer is really the small business owner. And so, our belief is that we need to build technology to provide the best customer experience possible to them. I think it's also important to build technology to be able to afford the human touch. And so, one of the first hire we made, which was interesting, was a guy named Jerry Weiss, who was the head of risk at Citibank for small business lending. And I think one of the interesting opportunities that he saw, certainly within the bank, was how long the process was, and actually how little data was often being used in the underwriting decisions. And so I think the emergence of sort of these online financial software platforms that had a wealth of data now accessible via API enabled us to provide him with more information on a $50,000 credit than he was often getting on a $1 million loan. And while we've shrunk, the time to funding from 4 to 8 weeks to 48 hours, ultimately the view is, we should get this to 4 to 8 seconds, right? I think in the future it's, auth access with QuickBooks, log into your LinkedIn account, and give us your social, and you should be instantly approved, on your phone and directly deposit in your bank account immediately. And I think, so I think that's sort of the future where we're headed. And, will enable us to scale without needing to throw people at the technology, but instead, leverage the technology we build.
I think I would agree. I'd agree with all of that. And certainly, for us, it's a bit different. When we're underwriting $2 million credits, we're not in a world yet where I think we could do that purely with technology. I think people make good credit decisions, and what we're working on is technology to make our credit analysts much more effective, and then over time build up a data set that can allow us to automate. But there isn't anyone that's got a data set of $1 million loans big enough to really say they could with confidence underwrite 100% every time. I think for us, the other piece of technology that's hugely important is our investor syndication platform. We really believe that being able to take a $1 million loan and syndicate it out $1,000, $25, at a time is a huge advantage for us, and it lets us do loans that other, offline alternative lenders and banks can't do. So we have put a lot of money into our syndication platform and feel it's a huge advantage for us.
Yeah, for Avant, our average loan size is $8,000, so it's not $50 or $1 million. And so for us, technology and really creating a user experience that is in fact real-time, automated, transparent is primary, as well as how we use data and analytics to drive better pricing for consumers. And so we have about 750 employees in the company, which includes our operations center. If you take that out, we have about, call it 300 people. Over a third of those are technology and data folks. And we're looking to double that team over the next 12 months. And very much focused on how do you go from 50% of consumers getting approved with no human interaction, which is where we are now, to 80%. And really making that experience as seamless as you can. We launched an app about 3 months ago. It's doing really well, but I think the idea of empowering users at mobile and really giving them the power to control what they want to do is really the key.
Technology is absolutely critical for us, and our COO, Juan Lorenzana, he was able to bring over a very innovative and well-heeled team. They started out in telephony, 15, 20 years ago, and then they went to transaction processing. The whole team went over to a company doing transaction processing. We were able to get them over to us. And what we can do now in construction is on a project by project, lot by lot, building by building, suite by suite basis. We can know who all the contractors are, all the suppliers supplying materials to that project. And with this data and information, we can also know the transactions, who's transacting monies up and down the chain. Because of that, we can make better credit decisions. And it's that technology that allows us to underwrite these contractors, and now we can provide these contractors. Again, it's a $1.7 trillion industry, and it's in the industry. There's a term. They say it that to build a building, it's financed from the bottom up. And although the big banks and the lenders are up top, the guys down at the bottom, they didn't get the money until the very end. And so it's taking that technology and making better decisions so we can provide those revolving lines of credit to these contractors.
So one of the fun things about technology is we get to talk a lot about a world in which we're not yet in, but that technology can enable. And so along the lines of one or two of the things that have been discussed right now, I just want to lay out a world that we very well might live in our lifetimes, and that's a world in which you click one button and you're approved for a loan. And the first time you hear that, you think, well, that's impossible. It's just too complicated. There are too many things going on. But the more you think about it, what you realize is that a lot of our data is getting more and more digitized. And as it gets more and more digitized, it lives in different pieces of the cyber world. And as it lives in different pieces of the cyber world, technology really is an enabler of pulling pieces of data that live in different places. And to the extent that disparate data sources now exist can be unified in some capacity, heavily leveraging technology, you start to think about a world in which a one-click underwriting, one-click loan process isn't too far, too far out of this world. And so that for us is an aspiration, one-click lending. No one's quite there yet, but we understand conceptually how we get there, and we're bringing those concepts to our process to date. So on our platform, where it is not atypical to get your rate in 2 days, we can actually book a loan within those 2 days, fully through the entire process. So I'd say relative to the industry, we're doing well, but relative to the aspiration, there's a long way to go.
Terrific. Well, that's fascinating to hear how technology is playing into this industry and really facilitating what you all are doing. So that's very exciting. Maybe kind of an extension of that question. I know, David, you touched on this, and both of you in your remarks. I wanted to kind of understand, technology facilitates process, and I wanted to understand at some point, we all aspire to get to a point where we consider it to be scalable. And I know, David Klein, you talked about that might even have implications in terms of the form and the capital structure that you're pursuing. So talk to me or provide some feedback or comments, if you would, on how you think about scalability and what are you doing to scale the business and what's your strategic plan to sort of achieve that scale?
Sure. So I think when we think about scalability, there are a number of different contexts of scalability. There's liquidity and capital, there's risk and underwriting, there's operational scalability. I'd like to focus on one piece of operational scalability just for the purpose of this question, and that's something that generally gets the question, well, how is that scalable? And that is providing phenomenal customer experience. We've heralded ourselves as wanting to provide the best customer experience, not just in finance, but period. Finance is a nice place to experiment with that because customer service is pretty crappy right now, generally speaking, among financial services firms. Just to give some data there, the Net Promoter Score, which I'm sure many of you are familiar with, or NPS, for some of the best service brands across the country is in the 80s. For financial services as a group, it's in the teens. At CommonBond, as an example, not of the financial services, but more on the former, and that is the services brands, our NPS is actually in the 70s. And so we get the question a lot, well, is that really scalable? And my answer is absolutely. What I would say to that is if you hire the right people, if you hire for intellectual horsepower, empathy, and competence, and you have people who come on board a couple years out from schools like Penn and Duke and Cornell, as we do, and you put them on the phones with our borrowers and applicants and on live chat and on email, you're able to more efficiently and effectively serve the customer. We also heavily leverage technology, so about 94% of all of our borrowers sign up for automatic debit. Once they sign up for automatic debit, their need to use our servicing platform is not so great. So I do believe that great customer experience is scalable. In my work at McKinsey advising financial services clients, I saw when it worked and when it didn't. And we're putting in play principles of success as it relates to scalable customer experience from what I saw there, as well as what we're seeing from our own customers in the past 2 years or so.
Terrific, thank you. Would anyone else, let's go on a volunteer basis. We have about 5 minutes left. And so would anyone else like to touch on scale, how they think about scale, how that really plays into their model?
I could jump in there. Looking really at the capital side of it, because for Avant, the limiting factor to scalability historically has always been capital, and not equity capital, but more funding for loan capital, and really in the forms of warehouse lines from big banks and securitization, which we recently completed our first securitization, and then one of our partners, Jefferies, completed their securitization of loans bought from Avant. But these were unrated transactions, and Jonathan talked about the sum. I think getting to rated ABS transactions is a huge focus for us and really for the industry, because it opens up the size of that market dramatically, and getting rating agencies comfortable with the fact that none of us have that much data. We're only 3 years old. It takes time. You can't produce 5 to 7 years of data and data through cycles. So I think that is something that we all just need to deal with and have constructive conversations with our various lending partners on how we get them to accept that there will be a cycle at some point, and this is likely what the performance will be. Here's the steps that we take to protect you as the investor, but get you comfortable with participating in these platforms.
Terrific. Thank you, Al. Okay, and maybe as a lead in to the next question, then talk briefly, if you would, about your interaction in the capital markets, specifically with respect to debt investment. So, John Barlow, described sort of from an investor's perspective, trying to secure the process of trying to secure debt capital from a few years ago relative to today. So I guess the question I'd like to pose is, what hot buttons do you find come up in conversations with prospective debt sources, and what can you kind of tell us about the landscape as it stands today and accessibility to debt?
Well, to take off from the previous question in scalability, and what folks are looking for from us is understanding our collateralization techniques and then our process and systems, as I mentioned, so that we can track and monitor the folks who we provide these revolving lines of credit to. And it's that, and having them understand that we are reducing risk, and the ways that we can reduce risk can then bring additional capital, reduce those rates, get lower rates, that then we can expand faster into the market.
I'd say it's quite simply risk, return, prove it. From a debt capital markets perspective, it's really those three things: risk, return, prove it. Al made an astute point earlier about having recognized that as a marketplace lender, it might take a little bit more time to grow and develop because you have to meet the demands of a disparate set of investors as opposed to lending directly. I do think that in our case, we ring-fenced our risk significantly in the beginning. We launched at just 20 MBA programs. Today, we're in pretty much all Title IV institutions, over 2,000 across the country. And we did that by having to start small to reduce the risk associated with a debt investor coming in and investing on our platform. Over the last 2 years, been able to prove out operationally and from a risk perspective that we're able to do it. In student loans, you would expect to see about 50% of all defaults happen in the first 2 to 3 years. We've been in existence now for 2 years. We have yet to have a default. And so when we went to the capital markets and did our first securitization back in June, that was one of the things that the capital markets rewarded highly. We were, in fact, able to get a Moody's investment grade rating in that transaction in addition to DBRS. It was the first time, actually, that Moody's provided an investment grade rating to a first-time issuer in marketplace lending. So I think whether you start as a direct lender, as Avant has, or whether you start as more of a marketplace lender, you've got to prove pretty significantly and meaningfully in the data before you tap the capital markets that your operation can perform quite well and will likely perform well over time.
Terrific. Well, I'd like to thank you all. Unfortunately, we are now out of time, although I could sit and listen to this probably for 3 or 4 days straight. But unfortunately, we've got to come to a close. But again, thank you to our great set of panelists here. And why don't we give them a great round of applause. Thank you.